Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with the revision. Right guys, let us start on with revision of accounting standard 12, accounting for government grants. First we'll cover the contents of the standard and then we'll discuss some very important practical questions. So let's begin. Accounting standard 12, accounting for government grants. Basically these government grants are help or assistance which is provided by the government. This assistance can be in form of cash or can be in form of kind, means some non-monetary assets may be provided, but this is provided to an enterprise basically for either the past or the future compliance of certain conditions. So whenever we talk about grant, we think about a gratuitous act, that something is given free of cost, but here the government is providing assistance to the enterprise, but this is not free of cost. The enterprise is supposed to comply with certain terms and conditions. Either it has complied in the past or it has to comply in future, and by virtue of complying with these certain terms and conditions, the government will provide a subsidy or a grant. So government grant has been defined as government grants are assistance by the government in cash or in kind. Maybe some land is given or maybe a plant and machinery is given, whatever the case may be, to an enterprise for past or future compliance of certain conditions. So how it normally works is, let's say the government want to develop a certain backward area, create employment opportunity, utilize the land pool which is available there. The government will come out with an incentive scheme that whosoever sets up their factory or undertaking in that particular area may get certain money as an incentive in terms of, let's say, setting up of their factory, or may get certain tax concessions, or maybe their let's say employee cost will be reimbursed. So that can be formed in various ways, but it is an help or an assistance which is given by the government to a business for complying with certain terms and conditions. Let us see the recognition criteria for government grants. Government grants are recognized when these two conditions are satisfied. First, that there is a reasonable assurance that the enterprise will comply with the conditions attached to them, because it's not gratuitous. It's not just that we're just giving you assistance. You have to comply with certain terms and conditions and become eligible to get the government grant, and such benefits are earned by the enterprise, and it is reasonably certain that the ultimate collection will be made. So practically how it works is that, let's say the government comes up with an industrial development scheme whereby it provides a pool of incentive to a business house for complying with certain terms and conditions. For example, let's say if you set up your business undertaking in this particular area, whatever cost you incur, will reimburse 30% of the cost that you have incurred. So maybe then a company sets up its factory there, maybe it incurs 50 crore rupees of cost. So what the company will have to do, the company will have to set up its undertaking there, submit the required documents and proof to the government department that it has complied with all the conditions which are set forth in the grant. The government will verify those documents and then approve the grant. So moment that grant is approved, it may take certain number of years for actual disbursement of money to come to the business, but once the government approves the grant, that is the point of time, right, when the recognition of government grant is made in the books of accounts. So government grants are recognized where there is reasonable assurance that the terms and conditions will be complied, the benefits have been earned, and there is a reasonable certainty that the ultimate collection will be made, and the reasonable certainty of ultimate collection will normally arise when the grant has been approved by the government. Mere receipt of the grant is not necessarily a conclusive evidence that the grant has been earned, in terms of maybe there might be a scenario that the grant has been provided by the government and the enterprise will have to comply with certain conditions in future. But just the fact that the grant has been received does not mean or does not provide the basis for recognition of grant as an income, because if the terms and conditions are not satisfied in future, the government may require the enterprise to refund that grant to the government. Now we'll talk about the accounting treatment of government grant. There is two school of thought. One school of thought says that you should follow the capital approach and you should treat the government grant as part of the shareholders fund. Normally we credit it to the capital reserve account. Another school of thought says that you should follow income approach. The government grant received received should be treated as your income and should be credited to your statement of profit and loss as and when the benefits are received on an accrual basis. Now what should be the treatment, whether you should follow capital approach or whether you should follow income approach, depends upon the nature of the government grant. So if the nature of the government grant is of a promoter's contribution, means the grant has been provided based on the volume of investments which you are making. For example, let's say the government says that if you set up a factory in this particular area, whatever cost you will incur, we will reimburse 50% of that cost. So the government is operating like an entrepreneur, like a promoter, along with the person who is setting up the factory, and the government is reimbursing a part of the cost which is incurring setup of the factory. These grants will normally be treated as a promoter's contribution, and if the grant is in the nature of promoter's contribution, you should follow capital approach. For other grants, right, for other grants you should follow the income approach. So for grants which are similar to the promoter's contribution, you should credit it to the shareholders fund. Where do we credit it in the shareholders fund? We take it to the capital reserve. For other grants, you should follow income approach and recognize the grant on an accrual basis over the period to match the related expenses. Now, there are two circumstances under which the receipt of government grant is treated as extraordinary item. Normally the receipt of government grant is not an extraordinary item, but only under these two scenarios the receipt of government grant will be treated as an extraordinary item. One, when it is received as an immediate financial support, maybe that particular industry or that particular undertaking is going through financial hardship, and to bail that entity out, the government has provided some grant for immediate financial relief, or it is as a compensation for expenses or losses incurred by that enterprise in the previous accounting period, right? So in this case, right, there are no terms and condition it had to comply, right? It has been given to survive that particular enterprise, and therefore these will be treated as extraordinary items. Now we'll talk about the treatment of various kinds of government grants which an enterprise receive. Normally we can let's say cover it in certain categories. The government grant could be of a non-monetary asset, it could be for a specific fixed asset, it could be in the nature of revenue, or it could be in the nature of promoter's contribution. We'll look at treatment of each one of them. Non-monetary government grant. Non-monetary government grants would mean that the government is not providing support in terms of cash disbursement, but it is providing certain asset to the enterprise. Maybe it is providing land, maybe it is providing plant and machinery, etc. So grant in form of non-monetary assets such as land or other resources. It could be two scenarios. Either the land is given to you at concessional price, maybe the cost of the land or the price of fair value of the land in a particular area is 10 crore. The government is providing you this land for 5 crore. This is treated as providing non-monetary asset as a concessional rate. Another thing could be it is given free of cost. It says that you set up your factory here, we'll give you, let's say, land free of cost. So if the non-monetary asset is given at concessional rate, the rate at which you have received it should be accounted as the cost of the asset. So if I buy it from the market, I would get it for 10 crore, but the government is giving me at concessional rate at 5 crore. So I should pass an entry land account debit 5 crore to government grant account, or let's say land account debit 5 crore to cash or bank account 5 crore, because 5 crore was a benefit and 5 crore was the actual cost which I had incurred in acquiring that land. If the land is given free of cost just for the purpose of identification in your books of accounts, you should record this land at some nominal value. Now what is this nominal value? It depends upon the size of your balance sheet. It could be 1 rupee, 10 rupee, 100 rupees, just denoting a value so that this asset can be identified in your books of account. Now presentation of government grant in relation to specific fixed asset. There are two approaches which could be followed. Right, we look at the treatment of the two approaches. In method 1, the amount of grant received is reduced from the cost of the asset, right? And if the amount of grant covers the entire value of the asset will be shown as nominal value. We'll do it with the help of an example. In method 2, we'll see whether this grant relating to specific fixed asset is in relation to a depreciable asset or is it in relation to a non-depreciable asset. If it is in relation to depreciable asset, we will treat the government grant as a deferred income and we'll credit the amount of grant in the same proportion in which we debit the depreciation expense in relation to that asset in the statement of profit and loss. But if the grant is in relation to non-depreciable asset, we'll straight away take this government grant into capital reserve. So two approach: one, you let's say deduct the amount of grant from the value of the asset and depreciate the remaining value over the useful life of the asset. If the amount of grant covers the entire value of the asset, record the asset at some nominal value. Second approach, you see whether it's in relation to depreciable or non-depreciable. If it is in relation to depreciable asset, treat the amount of grant as a deferred income and credit some proportion from the deferred income to the statement of profit and loss in the same proportion in which you are charging depreciation on the asset in relation to which you have received this grant. If it is in relation to non-depreciable asset, you straight away take the amount of grant to capital reserve. We'll do it with the help of an example method. One way we'll reduce the amount from the amount of the fixed asset. X Limited purchased a machinery for 5 lakh which has a useful life of 5 years. The government provided a grant of rupees 2 lakh. So when we purchase the plant machinery, we'll say machinery account debit to bank 5 lakh. When we receive the government grant, we'll say bank account debit to machinery account 2 lakh. So by this now the machinery is appearing in the books of accounts at 3 lakh. Now we'll provide depreciation on this amount of 3 lakh, 5 lakh minus 2 lakh, 3 lakh divided by useful life 5 years, we'll charge depreciation 60,000 per year. If we are following method 2 under the same circumstances, X Limited purchased a machinery on this date for 5 lakh which has a useful life of 5 years and government provided us a grant of rupees 2 lakh. Now this is a depreciable asset, we'll treat this 2 lakh as a deferred income, right? So we'll say machinery account debit to bank 5 lakh. Bank account debit to deferred government grant account rupees 2 lakh. Now we'll depreciate this asset over a period of 5 years. Therefore 5 lakh divided by 5, 1 lakh will be the depreciation charge on this asset. Now this 2 lakh has to be credited to the statement of PL over the useful life of the asset. So 2 lakh divided by 5, 40,000 will be credited to the PL over a period of 5 years. Now see the net PL charge in the first method, the depreciation will be the PL charge. The net PL charge under the first method was rupees 60,000. In the second case also, the depreciation is the PL debit, whereas government grant is PL credit. Debit 1 lakh and credit 40,000. Net PL hit is 60,000 in this case as well. So under both the method, the amount of depreciation or the amount of charge to the PL remains the same. Just the method of presentation differs. In the first case, we reduce the value or the amount of government grant from the value of the asset. And the second case, we are treating the amount of government grant as a deferred income. Then presentation of government grant in relation to revenue. If it is in relation to revenue, credit the amount to the statement of profit and loss. Either you can show it separately or you can merge it under other income. Another option is deduct the amount in reporting relevant expense. For example, the grant is in relation to employee cost, right? Whatever employee cost we are incurring during the year, 20% of that cost is reimbursed to us in form of government grant. So it says you may net off that particular grant with the amount of your expense, but this approach is not considered appropriate because it will conceal impact of two items. My salary expenses will be understated and the amount of grant which I have received will not be reflected in the financial statement. So it is better that you show your salary expense at full value and on the credit side you show the amount of grant which has been received. Now presentation of government grant which is in the nature of promoter's contribution, this should be treated under the capital approach and it should be taken under the taken to the capital reserve. You will do bank account debit to capital reserve. Now we will talk about refund of government grant. See, the government grant is not gratuitous. You have to comply with certain terms and conditions and then only you become eligible to get the government grant. Even after getting the government grant, if you are non-compliant of certain terms and conditions which are associated with the government grant, the government may require you to refund that particular grant. So government grant are refundable because certain conditions are not complied, right? This will be treated as an extraordinary item because normally it is believed that the enterprise will recognize government grant only when there is reasonable certainty that you will comply with the terms and conditions. The government grant is, let's say, earned and there is no doubt about the ultimate collectivity. But you let's say receive the government grant, subsequently you non-compliant with certain terms and conditions, you will need to treat this refund as an extraordinary item. Now we will see how do we treat with the refund of the government grant. So refund of government grant in relation to revenue means which has been recorded under the income approach. So if there is a deferred credit, if there is a deferred credit which is there in our balance sheet, in relation to the grant which has become refundable. First, you will debit the unamortized amount in the deferred credit, means such an amount, right, which is balance in the deferred credit account which you have not credited the PL till the date of the refund. If the amount of refund exceeds the unamortized deferred credit, then charge the excess to the statement of PL. We'll look at it with the help of an example, right? Let's say, or maybe complete the another scenario and we'll look at it both together. Where no deferred credit exists, right, you need to charge the refund immediately to the statement of profit and loss. So two scenario, if there's a deferred credit to the extent of balance there in the deferred credit, right, you reverse that credit, you will have to debit the deferred credit in relation to the government grant. If the refund is over and above the balance in the deferred government grant account, you need to debit the PL. And if there is no deferred credit in your books, very simple treatment, let's say debit the grant to the refund of government grant to the statement of PL. Let us look at it with the help of an example, it will be clear. X Limited has purchased a machinery on 1/4/2017 for rupees 5 lakh, which had a useful life of 5 years. Government had provided a grant of rupees 2 lakh, which had been treated as deferred income, right? You have treated this amount of 2 lakh as a deferred income. On 1/4/19, when the balance in deferred government grant account was 1,20,000, so on 1/4/19 the balance is 1,20,000. The grant became refundable due to non-compliance of the condition, and the amount of refund in first case is 1 lakh, in second case is 2 lakh. So if there is a deferred credit, you have to reverse that deferred credit. The balance in deferred credit is 120, whereas in the first case refund is only 1 lakh. So your entry will be deferred government grant debit 1 lakh to bank account 1 lakh. Balance 20,000 will be credited to the PL as per the proportion of depreciation on the asset. In the second case, the refund is 2 lakh. The balance in the deferred grant account is only 1,20,000, whereas the amount of refund is entire amount of 2 lakh. In that case, we will debit the deferred grant account with the amount of 1,20,000, which is the extent of balance in that. We paid back 2 lakhs, so the difference amount will go to the statement of profit and loss. Now we'll talk about refund of government grant in relation to specific fixed asset. So we have already discussed that when we receive the government grant in relation to specific fixed asset, there are two treatment we need to do. First, either we can reduce the amount of grant that we have received from the book value of the asset, or the second treatment is that if it is a depreciable asset, we'll treat it as a deferred income, and if it is a non-depreciable asset, we'll credit it to the capital reserve. So if you have reduced, if you have taken the first method, if you have reduced the amount of grant from the book value of the asset, when you are doing the refund, you have to increase the book value of the asset. So increase the book value of the asset, and depreciation on the revised book value is provided prospectively over the residual life of the asset. If you have taken it to capital reserve, you reduce the capital reserve, you will debit the capital reserve and you will credit the bank account. And if it is deferred income, we have already seen the treatment, deferred income will be debited, bank will be credited. But if the refund is more than the amount of deferred credit, then you have to debit the statement of profit and loss. Then refund of government grant in relation to promoters' contribution. When the grant was received, it was taken to capital reserve. When the grant will be refunded, it will be debited to the capital reserve. You have to reduce the capital reserve account. Now, what disclosures do we need to make? We need to disclose the accounting policy in relation to government grant and the method of presentation of government grant in the financial statement, the nature and the amount of government grant recognized in the financial statement, including grants which are of non-monetary assets, either given as concessional cost or if they are given at free of cost. So by this, we are done with the contents of the accounting standard. Now we'll look at the practical exercise. I have covered certain very important questions, so please concentrate and let's go through this. Question number 1. A Limited purchased the machinery for rupees 40 lakh. The useful life of this machinery is 4 years and the residual value of the machinery is 8 lakh. Government grant received against this machinery is 16 lakh. So this is basically a depreciable asset, and in relation to this depreciable asset, which is machinery, I have received a government grant of rupees 16 lakh. Here I have two options to deal with it. Either I can reduce this 16 lakh from the book value of the asset, which is the first method, or I can treat this 16 lakh as a deferred income, which is the second approach. So the journal entry to be passed at the time of refund of grant in the third year, right? The grant is becoming refundable in the third year, and the value of the fixed asset at the end, right? If the grant is credited to the fixed asset, so if the grant when it is received, it is credited to fixed asset, when it is refunded, you will debit the fixed asset account. So if let's say 16 lakh rupees is refunded, right? If the entire grant of 16 lakh rupees is refunded, at the time of refund, under the first method, my entry will be fixed asset account debit to bank account, right? My entry will be machinery account debit to bank account 16 lakh because the entire amount has been refunded, right? You know that we need to first state the particular para from the accounting standard and then we need to deal with the case. So we'll say as per accounting standard 12, accounting for government grant, the amount refundable in respect of government grant related to specific fixed asset is recorded by first option increasing the book value of the asset or by reducing the capital reserve or the balance in deferred income as appropriate. Originally what treatment you do, you need to choose based on that. By the amount refundable, where the book value of the asset is increased, depreciation on revised book value is provided prospectively over the remaining useful life of the asset. A government grant that become refundable, very important, is to be treated as an extraordinary item. So in the first case, right, when the grant was received, you made an entry bank account debit to machinery account. When it is refundable, you will make an entry machinery account to bank. In this case, the receipt of government grant is credited to the asset account. Therefore, asset account should be debited when the amount of grant is refunded and the revised book value should be depreciated prospectively over the remaining useful life of the asset. So here you will have to debit the asset account and credit the bank account. Let us look at the value of the asset. See, when the machinery was purchased, the cost of the machinery was 40 lakh. We credited the amount of grant to the value of the machinery. So 16 lakh which was received, we credited it, and the net value of the asset, right, in our books was 24 lakh. We provided depreciation for 2 years. 24 lakh is the book value, 8 lakh is the residual value, and divided by 4 is the useful life into 2 years, which we have already depreciated. So 8 lakh depreciation already provided by us. Book value at the beginning of the third year is 16 lakh. We made a refund of government grant of 16 lakh. So we added this 16 lakh to the value of the asset. So revised book value at the end of the third year will become 32. Now it says the book value has to be depreciated prospectively over the remaining useful life. Out of 4 years, 2 years already gone. So now this 32 lakh has to be depreciated over the period of remaining 2 years. So depreciation will be 32 lakh, which is the book value, minus 8 lakh rupees, which is the residual value, divided by 2, which is the remaining useful life. So 12 lakh will be the amount of depreciation, and the carrying amount of the asset will be 20 lakh in the first case. Now the second case says that the grant is credited to deferred grant account, right? So you did not adjust with the value of the asset, right? You took this 16 lakh to your deferred grant account, and in the same manner you provided depreciation. You credited some portion from the deferred grant account to the PL. So we'll see how do we deal with this. See, first we'll look at the balance in the deferred grant. Amount which was credited to the deferred grant is rupees 16 lakh, because 16 lakh worth of grant we had received, right? This is for 4 years. The useful life of the asset is 4 years. So 16 lakh divided by 4 into 2, right? We would have credited 8 lakh rupees to the PL, and at the end of the second year, there is a balance of 8 lakh rupees in the deferred grant account. So this balance we need to debit. So we'll say deferred grant account debit 8 lakh. But since our refund is 16 lakh, right, we need to debit PL by the remaining amount of 8 lakh. And we look at the value of the machinery. The value of the machinery is 40 lakh. We did not credit the grant, so we'll provide depreciation 40 lakh minus residual value 8 lakh divided by 4 into 2. 16 lakh is the depreciation provided in the asset, on the asset for 2 years. So book value becomes 24. Right, third year depreciation will be on 20, let's say 40 lakh minus 8 divided by 4, 8 lakh, and this will be the carrying amount at the end of the third year. In this case, there is no impact on the asset because we did not adjust the value of the grant on the asset. We treated the grant separately. We treated the grant as a deferred income. So here the asset accounting will not be impacted. Only when you are refunding the government grant, you need to debit the deferred grant account, and over and above the balance in the deferred grant account, the amount will be debited to the statement of profit and loss. Let's go on to the second question. Santosh Limited has received a grant of rupees 8 crore from the government for setting up factory in the backward area. So since Santosh Limited has set up factory in the backward area, it has received grant of rupees 8 crore. So this grant looks as in the nature of promoter's contribution, which is provided by the government based on the investment made by Santosh Limited in the backward area. Out of this grant, the company distributed 2 crore as dividend. Also, Santosh Limited received land free of cost from the state government, but it has not recorded it at all in the books of accounts as no money has been spent. So two things. First, it has received 8 crore, out of which it has spent 2 crore as way of dividend. You cannot give dividend out of this because the government grant has to be used for the purpose. So it is for the purpose of setting up a factory. So this 8 crore is to compensate your capital cost. So it should be used for that purpose itself. Second, the state government has given land free of cost. It is not recorded it at all in the books of accounts, but AS 12 require us that if a non-monetary asset is received free of cost, that should be recorded at nominal value. So the Santosh Limited should have recorded this as nominal value. In light of AS 12, examine whether the treatment is correct or not, right? So both the treatment are not correct. So we'll say as per AS 12, government grants available to the enterprise are considered for inclusion in the accounts. This is the recognition criteria where there is reasonable assurance that the enterprise will comply with the condition attached to them, where the benefits have been earned by the enterprise and there is reasonable certainty that the ultimate collection will be made. Mere receipt of the grant is not necessarily a conclusive evidence that the conditions will be complied. Then it says where the government grant is in the nature of promoter's contribution, they are given with reference to total investment in an undertaking or by way of contribution towards its total capital outlay, and no refund is ordinarily expected in respect thereof. The grant is to be treated as capital reserve because it is in the nature of promoter's contribution, which can neither be distributed as dividend nor can be considered as deferred income. So giving this as dividend is incorrect. In the given case, Santosh Limited has received a grant of 8 crore from the government for specific purpose of setting up factory in the backup area. When government grant is received for specific purpose, it should be used for that purpose. If it is not used for such specific purpose, it will result in non-compliance with condition of the grant and may lead to claim of refund of the grant by the government. In light of the above, giving of dividend of rupees 2 crore would lead to non-compliance of the condition and may result in appropriate action being taken by the government. In the second case, when non-monetary grant is received, right, in form of non-monetary asset given at free of cost, the same should be recorded in the books at nominal value. Based on the above facts, Santosh Limited should record the receipt of the land at free of cost at nominal value, which should be 1, 10, 100. Based on the size of the balance sheet, it should record it at an appropriate value. Now we'll go to sum number 3. Top and Top Limited has set up business in a designated backward area which entitles the company to receive from Government of India a subsidy of 20% of the cost of investment. So again, this looks in the nature of promoter's contribution because it is given based on the total investment which the company has made in setting up its business. Having fulfilled all the conditions under the scheme, the company on its investment of 50 crore in capital assets received 20%, means 10 crore of the crore from the government in January 17, which is accounting year 16-17. The company wants to treat the receipt of as an item of revenue and thereby reduce the losses on reduce the loss is on profit and loss account for the year ended 31st March 7. Is this treatment correct? Obviously no, because this grant is in the nature of promoter's contribution which is being given based on the total outlay or investment in the undertaking. So it should be treated as in the nature of promoter's contribution and it should be credited to the capital reserve. It should not go to the income. So this is what we have stated here. In the we have noted the text from the standard. In the given case, Top Limited has received government grant of rupees 10 crore based on total cost of investment made by it in setting up business in designated backward area. Therefore, the grant received by Top Limited is in the nature of promoter's contribution and should be treated as capital reserve. In light of the above, it is inappropriate on part of the company to treat this as an item of revenue and take it to the statement of profit and loss. Then we look at question number 4. How would you treat the following in the accounts in accordance with AS 12 government grants? Rupees 35 lakh received from local authority for providing medical facility to the employees. Rupees 100 lakh received as subsidy from central government for setting up unit in notified backward area. So in the first case, this 35 lakh is to compensate certain expense which the company will incur, because it is for providing medical facility to the employee. So the company is incurring certain expenses in providing medical facility, and the government is reimbursing that cost or the portion of the cost to the company. So this particular grant is in the nature of revenue. In the second case, 100 lakh rupees is received as subsidy for setting up of unit. So it is based on the investment made by the enterprise in setting up its unit. So this second item is in the nature of promoter's contribution, and it should be taken to the capital reserve. So we have quoted the text of the standard, then we'll say 1. In the given case, rupees 35 lakh received from local authority for providing medical facilities to the employee is a grant received in the nature of revenue grant, because it is to compensate certain expense which the company is incurring. It should be presented as a credit in the statement of profit and loss, either separately or under the general header other income. Alternatively, 35 lakh may be deducted in reporting the related expense, but this is not the most preferable treatment because it will suppress two different events. Second, in the given case, subsidy received from the central government for setting up a unit in backward area is neither in relation to specific fixed assets nor in relation to revenue. It is given based on the cost of investment in setting up the unit in notified backward area. Thus, rupees 100 lakh should be credited to capital reserve, because it is a grant in the nature of promoter's contribution. So by this we are done with our revision on accounting standard 12. If you like this video, do show your support to me by liking the video, by commenting your feedback, sharing it with your friends, and please do not forget to subscribe our channel and hit the bell button. Thank you so much guys. All the best.